Welcome to another episode from Stock Investing Simplified. I'm Randall Stewart and I will be your host and guide as we explore the wonderful world of stock investing together. In this how-to tutorial, you will learn how to set up a diverse stock portfolio with as little as 5 stocks. When you split your capital between 5 and 10 sectors, your time monitoring the individual holdings in your investment portfolio decreases. Since you will be investing in only one best-of-breed business in a particular sector or industry, your overall portfolio risk also decreases. In today's tumultuous markets, actively managing your money is clearly the safest and least reckless way to investing your money since you are in control. Creating a diverse stock portfolio has become much easier to do for the average investor compared to 20 or 30 years ago. The cost of purchasing and selling shares has dropped considerably over the years. Online discount brokers offer a bigger bang for your buck by providing many services and investment tools or resources that were once reserved only for the big players. This has evened out the playing field so that the little guy, like you and me, can enter the market and make a decent buck. It is simple to create a diversified portfolio in today's stock market. The key is to split your investment capital between 5 and 10 sectors. 5 is the bare minimum to be considered reasonably diversified. Having more than 10 stocks turns your portfolio into a part-time job, just in keeping track of your portfolio. Try to make purchases that are at least $1,500 so that commissions do not eat up more than 1% of your capital. Here is a popular overall portfolio breakdown made up of 10 stocks. A precious metal stock or exchange traded fund. Alternatively, you can buy gold and silver bullion. We are currently experiencing a strong precious metals market. An oil stock. Consider looking at well-diversified oil and gas producers as being your best bet. A brand name blue chip with at least a 2.5% dividend yield. These companies tend to be mature, internationally recognized businesses with a long record in the industry. A financial stock from the S&P 500. After the crash of 2008, this sector experienced one of the fastest comebacks, due mainly to the government not allowing the banking sector to collapse completely. A speculative stock with future growth potential in an upcoming industry. In 2010 and 2011, businesses servicing the mobile internet have done well. A medicine chest or fridge stock. These are recession-proof companies that are producing primarily consumer staples that everyone uses or needs on a regular basis. A high-quality cyclical stock. Cyclical stocks typically do well in good economic times when the economy is fueled by increased consumer spending. A technology stock, especially one from the mobile internet industry. A young, expanding retailer that hasn't gone national yet. And a hope for the future non-tech stock, possibly one in pharmaceuticals or alternative energy. As an active investor, you inherently take on the responsibility of doing your due diligence on each and every investment, as well as the ongoing weekly time commitment of monitoring your stocks in your portfolio. This is critical to your ongoing success as an investor. By taking the time to get to know each business, you begin to gain a better understanding of the industry, resulting in a greater level of confidence and satisfaction. As a final parting thought, strive to become more of an active, opportunistic, and intelligent investor. In doing so, you'll have a lot more fun down the road investing in all sorts of markets. I encourage you to get started today in setting up your own diverse stock portfolio.